Happy New Year to everybody. So again, I'm glad you're here. So we're going to kick off this new year with kind of a special earnings game plan, working webinar here today. So it's basically, how to capitalize on earnings season uncertainty and volatility. And I'm going to go through and show you a lot of different kind of option strategies that you can use to, capitalize on all the different potential earnings confusion and volatility. So that being said, let's get started. And again, thank you here. So, we're kicking off 2025. We'll start earnings here, shortly. We've got Citi and JP Morgan, the banks will start reporting early, around the 15th. But I wanted to get out ahead of everything to show everybody here, some different ways that you can take advantage of the uncertainty and all the volatility that surrounds earnings. But before I get started here, little background on myself. I've been actively trading in the markets for now. Started my trading career back in the 80s and started on the oil side. Started with a company called Coastal Corporation out of Houston, and they were actually at that time they would actually put you in a program if you got into it to train you to teach you how to trade crude oil and oil products and things like that. So I was able to get into the program there, which I was very fortunate and excited about. They sent me down to one of their refineries. They have a big refinery down in Corpus Christi, Texas, and spent about 3 months there. And it was a great experience because you learn the whole kind of foundation of oil and the process of bringing crude oil into a refinery, and putting out products like gasoline, distillate, things like that. So it really kind of grounded you as far as, the fundamentals, and then, went into the operations group with ship chartering, learned all about that. Finally got into the trading group for cargo trading and was really a short stay there in Houston, and then ended up out in Singapore for a couple of years with Coastal trading products and crude oil. So it was really, exciting, fantastic experience there. If you ever get a chance to go to Singapore, make sure you do. And then I was hired by a company called Transworld Oil, which was at that time they were the largest oil trading company in the world. It was Transworld, Fibro, and another company called Mark Rich. So we were the three big, energy trading companies in the world. But spent about 17 years there with Transworld. 16 were in Bermuda, which was the corporate headquarters, and ran the international trading desk out of Bermuda. So that's where I kind of started, cut my teeth on, trading options back in the mid 80s. And so never looked back, but it was exciting. We were in all the different markets, from foreign exchange, all the big energy markets and futures markets. So just got a lot of option experience, a lot of experience in general. So that being said, I wanted to, present a couple different really cool strategies here today that you can use to take advantage of earnings and go from there. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So if you do have questions, make sure to put them in the in the chat box, and sometimes they scroll off, so put it back in if I missed it, but I'd be happy to try to answer any of the questions that come up. So, have you noticed how, one second here. Have you noticed how, earnings, they can be horrendous and the stock, goes straight up? It's crazy, or earnings are off the wall chart fantastic and the stock tanks. This is what I call the earnings confusion. So, when a company has an earnings conference call scheduled, many times there's going to be speculation not only into the, accuracy of the projected earnings, the earnings per share, the revenue and things like that, but other things that may pop out that you're not aware of that the company's doing. It could be layoffs, it could be a takeover another company, or it could be a new product. So all this kind of uncertainty pops out on an earnings call, and this is what really can drive the volatility and the price of a stock as we head into earnings and after. So it gives a lot of potential opportunity as far as the trades. So it's this basic uncertainty that causes that increase in the volatility of the shares of a specific company going into their earnings. And this is the big, kind of the diamond in the rough. It's this temporary parabolic rise in the volatility that can spike option prices and the implied volatility. So it's a potential to take advantage of. So what basically happens is, traders tend to stay on the sidelines going into the days heading into an earnings conference call. But then all of a sudden, there's a lot of activity that starts to come in. You'll start seeing call buyers swapping out shares of their long option or long stocks, put it that way, for long call options, so they can, minimize the risk but still participate in the rise should the shares move higher. But this at the same time is, lowering their potential losses should the shares go lower. So there's that big swap out call buying that goes on. So this is one thing that really starts to put up the implied volatility. Now, additionally, you still have, the put buyers are going to come in, and that's also forcing the options higher as they try to protect their positions from any major downside movement. So it's all this concentrated option buying, and in many cases will dramatically expand the volatility levels of a stock being traded into their earnings release. So, as an individual trader, then we can take advantage of this, uncertainty and volatility in order to capture some, really great profits. So it can be done also without having to be, right as far as the earnings reaction. So, you just have to know the right setup. And once you understand the strategies, then you can kind of trade these kind of crazy earnings reactions, either from volatility collapse or from potential, price spikes. So step one is kind of to first identify and qualify a particular stock. And so what we do is I'll look back at its past performance, and I'll look at the probabilities of what that stock has done heading into its earnings release. So what we want to do is we want to find the stocks that have their earnings release also during a weekly option expiration. So we want to take advantage of using the weekly options to do these types of strategies that I'll go through. Okay, so that's one thing that we want. We want to make sure that whatever we're looking at, their stock is going to have weekly options that we can use. Now, the second step is we want to, again, look at that past performance. We want to look at that and look at the history of what a specific stock has done in the past and what the volatility of that stock has done previously as it moves closer to its earnings release and even after, or the post earnings. So this is one thing I'll look at. And so I'll kind of do a certain screen that we'll talk about, looking for certain kinds of parameters that I want. Now then, the prepared trader, you're going to look for that dramatic increase in the stock's volatility as it's approaching its earnings release. And typically a stock, you're going to notice that the volatility of stocks, tend to be about 25 to maybe 40%. But when we go into the week of the earnings, the volatility that then really can expand and increase, and a lot of times can go to sometimes 3 times the normal implied volatility of that specific stock. So this is what makes the stock a potentially great profit opportunity. It's that big increase in the volatility that again can sometimes double, in other cases being more extreme than that. And that's what we want to first look for in order to give us some opportunity as far as the kind of trades that we can do. So here's kind of an example of what you can see as far as the implied volatility, how pumped up it gets. So this was an example from NVIDIA back, like February the 3rd. Now look at this. This one, NVIDIA was trading at 270, but it's a good example just to illustrate implied volatility. So the earnings were going to be on a Thursday after the close, and then the next day was the option expiration. So this was the series being used. It was the 14 Feb series, 1 day to expiration. Okay, so this was Thursday, traded at $270. Now, here's what's unique and what we want to take advantage of. It's this really big, huge increase in the implied volatility. So you can see normally NVIDIA was having implied volatility of about 40% right here, you can see. But that week of earnings, 1 day before the earnings release or the day of the earnings release, it had knocked up to 114%. So like almost 4 times the normal implied volatility. Now, right here, you can see that it says plus or minus $17. So that's the implied expected move. So what that is telling us that with just 1 day to expiration, it's saying that theoretically, NVIDIA could go up or down $17, just 1 day. So that's huge, right? But that's just one standard deviation. Now, a lot of times we'll see, a stock can go 2 standard deviations or even more. So this, if you look at this based on like a bell curve, that would be one standard deviation. It could go up $17 up or $17 down, but a lot of times you'll see even more extreme ranges of maybe 2 standard deviations or even closer to 2.5. So it's a pretty crazy thing. And so there's different ways that we can take advantage of this unusual implied volatility spike to capture profit, no matter what the price of this stock does. So that's a really good thing. And that's what we call taking advantage of the volatility crush. Now, in this next slide, you can see this is the day after. Now you can see that the price had spiked up to 291, but the implied volatility here had collapsed back down to about that normal range of 35, right? So that's volatility crush. Now, the price then spiked up 7.5% to 291, and we had that volatility crush down. So this presented a couple different ways that we could take advantage of trading NVIDIA. And there are strategies that I'll show you that doesn't have to be, rightist worst direction. So these are non-directional type of earning strategies to take advantage of either price spike or implied volatility crush. Now, the days after the earnings release, you can see here from the chart what NVIDIA did, just from that chart standpoint to visualize it. So it was trading right here going into that earnings release on that Thursday. The implied volatility, you can see how it had been trending up here, and then it collapsed back to the normal implied volatility after all the uncertainty was let out. The earnings were released, earnings per share, revenue, whatever else. And so that uncertainty was just like popping a balloon, it collapsed. But not only did that collapse, but in this situation, we had a price spike up 7.5% just in one day. So huge potential opportunities there if you just know, the right strategies to use. Now, it's for this reason that we want to put together a watch list of stocks to monitor closely that have a potential opportunity to take advantage of these kind of earnings trades based on the implied volatility crush and price spike. So remember, the goal is we want to take advantage of that temporary rise in the volatility, as well as looking at the past history or performance of the probabilities of certain stocks, what they do. And so from the past performance history, then we can kind of get a better idea of what I call consistent kind of patterns of certain stock, what they do. Do they have big moves up, big moves down, or do they go nowhere? So that's going to tell us then what kind of strategy we can use. Now, the other thing that broken down, you're kind of notice that there's potentially like 3 type earnings cycle trades that can come up. And sometimes this can happen, one stock can have all 3. And so what we have is potentially a trend trade into the earnings release, okay? I'll show you what that is. And then we have what we call the earnings release trade, which is a non-directional type trade. We don't care if it goes up or down. We're going to be able to take advantage of it based on a couple of different strategies. And then the third potential opportunity is a post-trend earnings release trade. So let's take a look, and I'll show you what these kind of typically can look at. So first off, this is an example from CRM, and it actually had all 3 of these type of cycle trades. So the first potential trade would be a trend into the earnings, release date. Okay, so here is kind of the earnings release date right here coming up, and then you can see how the CRM started trending up. All right, started a really nice price trend. Not only did the price start moving up, but you can see the implied volatility is that teal colored blue line. So you can see it started to expand and rise to the upside. Now, when we take a price of the option price premium is based on the implied volatility and also your delta. So as your implied volatility goes up, that increases the price of your option. So you can see that implied volatility going up. All the uncertainty in the market, you start getting that implied volatility going up. And the second thing is you can see that also the price is going up. So this presents a great opportunity for a pre-earnings trend trade to the upside. Now, these types of trades, what you want to do is you want to do the options within that option series of that weekly option when it's going to, announce the earnings. Okay, so you want to be buying that option. So let's say it's, you've got the earnings coming up next week, and what is that? The January the 10 or the 11 expiration. So you buy that expiration taking advantage of the implied volatility going up in the options in that option series to take advantage of that. So that's kind of the way you play it. And then the second trade is the actual earnings release trade, when everything just collapses and you can take advantage of that collapse in volatility and even potential price spikes. So here you can see it's trending up on the implied volatility. Price is trending up, and we've got earnings here. So, you know, the earnings are released, and then boom, look at the price. It just goes up and down. It's just a huge move. But then it spikes back up and starts the third potential trend trade is your post-earnings trend. All right, so you can see it had this big, huge move, big move down and up, and then it started trending back up again after the earnings release. All right, so these are the kind of the three potential trades that you can be looking for, which presents, you know, a lot of different opportunities and different ways that you can trade into an earnings season. Now, a lot of times traders just, you know, sit on the sidelines because they don't know what to do. So that's what I wanted to do with this, you know, workshop today, is you point out a couple of different ways that you can participate and not have to be sidelined, you know, during a whole earnings season, which comes up, you know, 4 times a year. So here's one more example to show you the implied volatility move down and the spike. So here you can see just from right here, this was Nike, and you can see it, price had moved up, and then the implied volatility collapsed, right? Now here's another example. You can see Nike here is starting to trend down. Price is trending down into its earnings, okay? But as that price is trending down, what is implied volatility doing? It's trending up. And then after the earnings release, boom, in this example, it got a spike to the upside. So that's kind of typical of a lot of type potential trades and things that come up to specific stocks. All right, so that's kind of a good look there. Now, step 3 is we want to, I like to put together what I call a pre-earnings checklist to kind of systematize your trade setup process. So it's, you know, in trading, it's always good to take out as much of your emotions out of your trading. So the more systematic and mechanical you can make things, the better it is for your trades, so you're not getting too emotionally attached to it. So kind of the first step is this checklist. So first off, if you're looking at a specific stock to trade for the earnings, it has to, obviously, for what I'm looking at, the strategies I'll show you, it has to have options, and it needs to have good option liquidity, so you get a good tight bid offer spread. Now, it must also have pre-earnings volatility. So we want to see that, you know, a couple different strategies I'll show you, but one is that we want to see a good rise in the implied volatility to take advantage of that spike, to take advantage of the collapse. Now, I do a couple different screens. So the kind of 3 basic screens I'll look at is, first off, I want to look at stocks that move greater than 5%. So these will be the ones that potentially have the big price spikes to take advantage of. And then another screen that I'll do is I'll look for the stocks that maybe have a max of 5 to 7% move. So with these, I'm looking for stocks that take advantage of the implied volatility crush, and also one I'll show you here in a bit is, you know, to take advantage of any potentially, if we want to take a post-earnings trade off of it. So, you know, what I'll typically do is I'll look over like the last 4 earnings cycles to see kind of what the historical pattern has been over 4 cycles. So, you know, sometimes I'll go back even further. So I'll do that first. And then, you know, I'm going to look at stocks within the screen that are $30 or greater. So you don't want to start looking at stocks, you know, much less than 30 bucks, because then you don't have enough dollar movement to take advantage of. So kind of that's the kind of the screening parameters, 30 bucks on up. There are some other things I'll put in, but these are kind of the basic parameters that I'll do for a screen. Now then, you know, once I look at the list, you know, I pick out a stock, and I'm going to calculate the implied move of that stock the day of its earnings release. So I want to see exactly, you know, how much implied volatility has been pumped up, and that's going to be basically the last day. You'll really see the big impact of that. And then I look at that information, and then from that, I do what I call my price earnings target analysis. So I look at that expected move analysis, and then I can set, okay, theoretically, this could go up to this point, could be 1 standard deviation is what it's going to be based on, the expected move. So, you know, let's say it's trading here at 100, and the implied expected move is maybe saying it could go up or down $10, okay? So that will give me an idea, okay, where would my potential target to the upside or downside be based on the implied move. So that would be like one standard deviation, but then I might also want to know where that 2 standard deviation is so I can plan out the trade. So I do that price target analysis based on the implied expected move. And then based on this information, then I select the appropriate weekly option strategy that would align with this information, put together my entry plan, my exit plan, and then, going to be ready for the trade. So those are kind of the steps for each and every trade, kind of making it kind of as mechanical as possible, that good stuff. Now, if you ever, buy one of my courses and have a question, if you're thinking, well, did I already buy this? So all you have to do is just go into your course account, which you're going to have, and it'll list everything that maybe you own. So it might be that you bought my bear market strategy course, butterfly or whatever, or if you bought the earnings course, it'll show up, on your customers drop down in your profile. Okay, so that's where you can check that out. So I update this course, every quarter for the new earnings season, but that's where you can check that out. All right, so now going back here to Roku, question, is a synthetic stock position a good idea to use using earnings approach? Yeah, I mean, trending into an earnings, yeah, you could do a synthetic long or synthetic short. Yes, you could do that just as the trend in, but you want to be out of it before the earnings release. Okay, or you could do, synthetic long or short, after it, but you don't want to keep it on into the earnings release. Okay. Now here's the reason. So here's Roku to show you how this thing can explode. So here's Roku. Again, it was trading like here 137.50. Again, on a Thursday after the close was going to be the earnings release. So you can see then the next day, the option series was going to be expiring. The expected move on Roku going in was 11.64% up or down. So a huge implied volatility spike, right? Normally it's going for, about 50% implied volatility, and you can see it spiked to over 200. So again, it's showing you here that it could go up or down. It could go up $16 or it could go down $16 with 1 day left into Friday. Now that again would be just that one standard deviation, but typically when we have implied volatility like this, these stocks do more than one standard deviation. They'll typically do 1.5 or 2 is more typical of what they can do when you see that huge implied volatility. Now, the next day, you can see then what happens. Volatility just collapses, right? All that uncertainty is taken out, and now it's back down to kind of that normal volatility range. And you can see here the price had moved down 7% as well. So you had a couple different things to play there if you wanted. Either big price spike move or the implied volatility collapse, or possibly both. Now, here's a good kind of a data workup sheet to kind of illustrate this in more detail. So here's Roku, its implied move history. So this is going back about, I went back on this one about 8 different option series. So you can see the implied move history. It was typically 10.27% up or down, 11, 14, 14. So Roku has the potential for huge moves, right? That's showing you that on the history. But what we want to do is, what does it actually do? So then I go down and I look at the post earnings. What did it actually do after the earnings release? Where did the stock go at expiration? So for example, here you can see the earnings were on Wednesday, the 5th after the close, and then you can see that we had a move that 1 day later, well, kind of 1 day on the average. You can see here, typically it's Wednesday or Thursday. So you can see that 1 day later, it was down almost 7%, down almost 8%, down 6%, down 16, up 20, up 28, 25. So huge potential moves for Roku. So then when you kind of drill down and analyze that in more depth, put it on a spreadsheet or something, you can really see a pattern that really sticks out. So this was, again, going over those 8 cycles and then looking at the implied move history of what the theoretical move up or down would be over those 8 cycles, it averaged 14.5%. Now, but in reality, after the earnings expiration, the stock on average over those 8 cycles had moved up or down 16.7%. All right, so the smallest move was a 6% lower move, okay? So that tells you a lot. It tells you that, one, Roku has the potential for big moves, right? And so, with that in mind, then we can think, okay, well, how can I take advantage of that? If the worst situation over those 8 cycles was a move of about only 6%, was actually a little over, well, what if I did a trade setup where all I needed to do was move up 6% or down 6%? I don't care the direction, just have that kind of historic move that seems to be aligned with its the history of the implied move history. So if I could do that, that would be a 100% winning trade based on this past data. Now, and Roku has this tendency, it's still today, it's still a big, huge mover. All right, so that gives you an idea of how to kind of plan out a potential trade, right? And we'll go through these kind of setups here in a minute. Now, the next step, or step 4, is just the power of weekly options. So again, we want to use weekly options for all these types of earnings trades to take advantage of the two really key components of price. So that's going to be made up of your time component. And then the big part of the earnings trade component that we want to really take advantage of is that, escalated or implied volatility spike. All right. So the combination of these two components together, when we use correctly, is going to, create some really kind of low defined risk type strategy or trading strategy or formula that we can use to generate some pretty good returns in a very short period of time. So it's kind of what I call lightning in a bottle, because we can get some really great explosive returns really quick without having to stay in the trade. So it's like, if you can bottle that up and do it every time, it's it's like putting lightning in a bottle, and then boom, it's out, and you've got a great formula for some good trade success. Now, the next thing, if you just know which weekly option strategy to use for that earnings trade, then how to construct the trade and when to use it, and then these factors then can produce some really exceptional fast profits to the great leverage we're getting from those options, and it really makes it a great earnings kind of trade vehicle to use. Now, the next thing is, well, then how is it done? So the first thing is I do what I call, we'll do what I call comparative option strategy analysis. So what we're going to do is when constructing an earnings option trade, I want to look at the risk to the reward, or your return on your capital at risk you're putting up. And we're going to do that on the various different strategies we could use for a specific stock. So we look at the different strategies, and then we can compare the risk to reward and pick out the best one suited for our risk profile, or maybe the capital account that we trade. So at times there are going to be more than one strategy that you can use, but the first step is to kind of get an idea of what are the strategies and get an idea of what they are and how they work. So, for earnings trades, I use 5 different potential option strategies that can capture the profits from the extreme price volatility that surrounds these specific stocks heading into their earnings. Now, each strategy is best suited for certain circumstances. So I'm going to go through and show you kind of the different kind of scenarios of the different ones that you can use to give you an idea of when they would be used. Now, the 5 different strategies that I'll use is, one is called, these are non-directional as well. It doesn't matter if the stock price goes up or down. These are going to be based on either playing for a price spike, which would be a short iron condor, which is a debit spread. So this is one that we would use if we think that you could have a big price spike like that Roku or something. Okay. Now the other ones are going to be the long iron condor. These are for volatility crush. When we get that really big spike in volatility, we want to take advantage of that with certain stocks that tend to have tend not to have these huge movements, so we can play the volatility crush. Okay, so this is one really great strategy to use. The other one is what we call the long iron butterfly, which is another one used for volatility crush. And then we have one that is a real favorite that is really cool. It's what I call my double lightning spread, which is basically a debit spread, which also takes advantage of volatility crush, but it also gives you the flexibility, what I call the flexibility to stick with the trade for a post-earnings trend trade. So you'll see what that really kind of means here in a minute. Now, and then the fifth one is, if you want to trade a post-earnings trade, and we can do this using what I call a pairs trade or a spread trade, going long or short for a post-earnings trend trade. So I'm going to go through and show you the variations here to give you an idea of what they look like. And then next Saturday, we're going to get into each of them in great detail to show you how they work and how to select them, how to scan for them. Now, the first one is the volatility crush. This is based on the long iron condor credit spread. And basically what this one is kind of designed for is to give you a trade that has defined risk. Now it's going to be non-directional, so we don't care if the stock goes up or down. We don't care about direction, okay? And then I do a kind of screen where I'm looking for increased trade winning probability. So what that means, I do a screen to really screen down and get very, very kind of defined stocks that meet the parameters that would align with selling volatility for the crush. Okay, so that's what you're going to learn in the course, the screen, how to set that up. Now, then once we do that, then it'll take advantage of any pre-earnings high implied volatility data that comes in. We're going to use that in the screen. And then we're basically with the trade, what we're doing is we're selling time and volatility to take advantage of that implied volatility moving up. Then it collapses down. And so we're going to take advantage of that by selling options to capture time and volatility collapse. All right, so that's kind of the general trade concept of the trade. Now, these are very short duration trades. These can be no more than 3 days. Typically, there'll be 1 day to 3 days on these types of trades. Okay, so we're trading these things, setting them up for non-directional to really take advantage of that implied volatility crush, because that's the key concept and design of these types of trades. So here's an example of one that we had set up on JP Morgan. So this was this past earnings cycle. This was back in July, and it was based on a volatility crush setup for JP Morgan. This was set up on the 12th of July this past year. All right, so just again, kind of going through the steps to kind of show you the process here. So this was the earnings data information. It was going to be on the 12th before the market opened. Look at the straddle price to give us an idea of the expected move. So typically, JP Morgan is not a huge mover, 2.84% up, 3.4, 2.75, et cetera. So we look at that, it tells us, okay, it's not a huge, crazy mover. So what can we do? Well, let's take a look at selling volatility, okay? So then you can see here from the data, 1 day later, after the earnings release, what happened? It was down 1.2%. Here was up down 6%. That was a bigger move than normal, but typically, not too much outside that range. Flat, up 1.5%, up 0.5% or 0.6%, 7.5%. So it tells us that, this is not a high flyer, big mover. So we can do a couple different strategies. We can do either a credit spread for volatility collapse, or this is another one that we have done a lot of times using what we call that double calendar, which I'll show you, or that special trade where we have that post earnings trade trend potential flexibility. So here's JP Morgan showing you the implied volatility, how it was, normally it's low volatility, 20, 25%, but you can see it's up like, 3 times the normal implied volatility, up to 73% implied volatility. Now that's going into the right before the earnings release, the day before, and then the day after. You can see right here, you see price was 207, price the day after was 204. So the price really didn't move much, but look at the implied volatility. It spiked up 73 over 73%. Now it's back down to the norm. So that shows you what we're taking advantage of in this type of trade to capture that volatility crush. So this is the chart, where it was trading. It was trading right here where that arrow is. And then we had a 1 day move was just right down here. It wasn't a huge move, but you can see the implied volatility collapse down. So here's the trade setup that we did, and this was what we call the Iron Condor credit spread. So this was set up on the 11th, and when it was trading, going out that day, it was trading at 207.57. And then the expiration of the option series that we used was the 12th, just one day later. Now it's trading at 205.93. So going into it, the expected implied move was it would go up or down about 3%. And then, looking back at the past 5 cycles to kind of give an idea, it was kind of in line with that 3.36%. So that tells me, okay, I can do a couple of different things. And so what we did with this one, we set up the Iron Condor credit spread for a move of 4% up or down. All right, so this was just a one-day trade, but this was to capture that volatility, implied volatility, spike and the crush that we get after it. So this ended up making $45 per spread or 22% return in one day. So these are what we call kind of a probability trade, just based on capturing without having direction involved, capturing that implied volatility collapse. All right, so this is the Iron Condor credit spread. So you can see down here, I'll show you here what it looked like. This was going in, we had a bear call credit spread, the 217.5, 220, and a bull put credit spread together. And we received a total credit of 45 bucks. All right, so this is kind of a one-day trade setup. And you can see the delta, just to show you this, that 217.5 was trading, actually a little bit more than 1 standard deviation out of the money, about 1.5. And then we did the put credit spread here with about a 16 delta. So these are the kind of things that I'm looking for, just kind of step you through it. And then here was what the trade setup looked like. So we had, these 2 credit spreads. So we had the Iron Condor shorted call credit spread together with shorted bull put credit spread here. And we received off that, that total premium of 45 bucks. Now, again, it's a probability trade looking at the data that shows us that JP Morgan doesn't have the tendency to have big moves, but this is a way we can play that volatility crush, with some decent controlled risk. So you can see that it went from 23, that went to 0, and the put spread, we got 22 bucks. So that's typical. Now you can make these tighter to bring in more premium, but as you get tighter on your range, that also increases the risk that it can, explode outside the range. So you've got to be, the big key to these types of trades is your selection process in your screen. Because if you do a credit spread on something like a Roku, that has a huge move, you would just get crushed, right? Because you're going to go through your short strikes, you're just going to lose every time. So it's really important that you get the screen right to make the right selection as far as the trade you want to do. So that's a kind of a basic kind of volatility collapse trade that you can do. Now the next one is for a big price spike, and this is what we call the Iron Condor debit spread. Okay. So this is one to use. Again, it's going to be a defined risk. So everything that I do and teach is going to be based on a spread. So we've got defined risk, and it will be a debit spread. So that's the risk is just going to be your debit spread. Now this is also set up and designed for just a non-directional trade. So we don't care if the market stock goes up or down. We just want it to go down or up big. Okay, that's the way we want to take advantage of that spike. So this takes advantage of that earnings release big price spike for specific stocks that kind of meet that parameter in the screen. So really explosive price spikes, trade duration, 1 to 3 days. So these are, again, short duration. So, when you get into earnings season, it gets kind of frustrating because you're kind of sitting on your hands, waiting for these trades to be done or earnings to be done, and a lot of times you're not sure what to do. But this gives you, a trading game plan if you want to take advantage of the opportunities that you get, and this is a really good one to use. And here's an example of one that we had set up. This was on Tesla. All right, so going through Tesla, just again looking at the past data to kind of give an idea if it has consistent pattern. You can see Tesla has the implied move history for it has the potential for big moves. Like here, implied expected move 8. The next one coming up is 8%, 9.3. So big potential moves. So then, combine that. Well, then what does it actually do? So here's going back, this is going back the October series. You can see Tesla closed up 26%. The series before that, the July earnings series, it closed down almost 11%. The April 2024, it closed up 16. In January 2024, it closed down almost 12%. The earnings season cycle before that, down almost 13 and 10. So you can see Tesla has huge potential move history for what it does. So that tells you, okay, well, what can we do with Tesla? Okay, let's do the long iron condor debit spread. So then you can even break it down more to really see it. So here's just going back 5 cycles, from that October 2024 to October 2023. You can see the implied move history. It tends to have an average of 8.36 up or down, but the actual, earnings, when it expired, you can see the average move up or down was over 15.5%. So you can see the last go around was up 26, down 10, 16, et cetera. So this tells us, what we can do if we do the right strategy. So set this trade up for, all I had to do was move 6% up or down. And based on that history, had a high probability of making a good profit. So this was going into the earnings release after the close on the 23rd. It was traded 246. Expiration 3 days later on the 26th. The expected move going in was for a move up or down over 9%. So set the trade up. All it had to do was move up or move down. Didn't care which way, but it moved 6%. So it's trading here. So set the trade up, and boom, it was trading down here at 219 at the end of the expiration series. So this one worked out perfect. And so here was the trade set up, looking for the big price spike based on that screen. So trade 246, and then set it up, expect to move there. So you can see when we took the trade off, it was up $160. This was the trade risk was 160. The potential profit then was 90. Okay, so this was doing a what we call that iron condor debit spread. So we're long call debit spread and put debit spread, 262.5, 265, 235, 232.5. And so these are the trades I'll be showing you and teaching you more in depth next week. But the key thing is the screening process, okay? Now here's the trade. So you can see where it went out. There was just, a big winner. So this thing was down 10.78%, and we set it up for, all it had to do was move down 6% or up 6% here or here, okay? So that was the trade, just 6% up, 6% down. We have a winning trade. So you can see here the call debit spread side was 75 bucks. That ended up, losing 75. But here you can see we had the put side. We had that part of the spread was 85 bucks, blew up to 250. So you can see where that profit came from there. So we had, we had on that we had $165 less the $75. So that was the profit of 90. That's a 56% return over that 3-day period. So that was a really cool trade there to take advantage of that. Now, the next one I kind of call the go-to strategy. This is a really cool one. And the reason this is so nice is because it's super low risk, but has potential really good reward, but also gives you the added flexibility, what I call flexibility, if you want to stay with the trade for a post-earnings trend trade, okay? So I call this the double lightning earnings spread. So it's basically what we call a double calendar. Really cool trade setup, the structure, and we do a lot of calendars, but this is a double calendar. So very low risk, as you're going to see. It's a non-directional, again, trade, which captures, low defined trade setup. Very, very low risk trade, but has a really good potential, reward to risk ratio. Again, takes advantage of that pre-earnings high implied volatility that we can capture the volatility crush. So it's a big component is we're selling time and volatility to do that, collect that volatility crush or collapse. But the big thing it does, it gives you the flexibility if you want to trade or stay with a specific stock after the post, after the earnings release. It gives you the tendency to stay for a post-earnings trend trade. So I'll show you how that works here in a minute. Trade duration on these could be 1 day up to 1 or 2 weeks, okay, the way we structure it. We did a really cool one last earnings cycle, which I don't have in here, but I'll show you at the course, where we did a trade on Halliburton, where we stayed with the trade 2 weeks out. It worked out really cool, really great. But these trades will always give you positive data, no time decay. And so one, we take advantage of volatility crush to play it, but also if we want to stick with the trade, we have that post-earnings trend trade that we can do. Again, what sets it apart from the other trades that sell volatility is that the potential to be adjusted into a directional trade after the earnings release. So this, provides you for the big potential profits from a post-earnings directional move. So that's a really big feature of this trade. So started using this back in 2020. Gosh, it's hard we've been using this for 4 years now. It seems like just yesterday we started using it. But this has really provided really great results of really kind of low risk trades that we can use. And so started the first earning trades that I started with the alert service back in June of 2019. And then this should be, this is the wrong date, this should be yesterday, but we've had 123 trades closed out, 88 winners, 16 break-evens, 19 losers. So we're a win rate of 84%. These are very, very selective types of trades that I do, and these are based on the screens that you'll learn next Saturday. So these again are unaudited, but it gives you an idea of the trades, what you can look for as far as these are the trades that are sent out. All right, so here's an example of how it works. This was on STZ, and this was one set up for that volatility collapse. And again, just kind of going through the earnings data history, you can see STZ here has a tendency to not have huge moves, 3.5% up or down, 3.66, very consistent around 3.5%, 4%. Okay, so that makes it a really good, stock for this double lightning. And so then you can see, well, what did it do at expiration? So 1 day later on its expiration, it was up 2%, down about 3%, flat, up 1.4. So not a big mover. So good potential trade for this kind of double lightning type trade setup. So that's what we did. So you can see here's what it looked like on the chart, so you can get a visual idea. So it was trading right here. And so this was trading at 242.33. The expiration was the next day. And the next day it was trading at 247. So right here. So we had that volatility collapse. So we took advantage of this, doing this double lightning trade setup with super low risk, but a higher potential return than the other strategies that I just showed you. So you can see here going into the trade, again, have that jacked up implied volatility, 86.45%. Normally it's, around 25 or so. So really spiked up. So this trade was set up on the 5th before the market opened. So the entry was on the 4th, and it was going to be on the 5th. It's the earnings were released before the market opened, so you have to do it the day before. So the day before it was trading at 242.33, and then set this up, and let's go through it. I'll show you how it works. So then the next day, you can see the implied volatility collapse, and now it's down to the norm, 27%. All right, so it went from 83 back down to kind of that normal range, and the price was, at 247. So what we did here was this double calendar. Now you can see this has a really great positive risk ratio versus when you do credit spreads, it has what we call a negative risk ratio. So you're risking more than what you potentially make. All right, so this trade setup is trade at 242.33. The expected implied move going in was theoretical move up or down 3.5%. So we set this up for all it needed to do was move up to 3% or down 3%. The break even of this was a 4% break even or down 5%. So you have these are very forgiving, big, huge break even range. So this is what it looks like. See, it's a double calendar, kind of looks like a double butterfly. So basically we had the call calendar 247.5 right here. We were targeting that, or if it moved down, we were targeting the put side, was a put calendar at 235. So this worked out perfect, and it went to our expected move range up 3%. So this was up right there at 247.50. So we had that calendar set up here where we were long the 12 Jan 247.5, short the 5 Jan 247.5, and then we had the put side where we were long the 12 Jan 235 put, short the 5 Jan 235. That's a calendar. Now it worked perfect up here and pinned pretty close to it. So you can see this went from our total risk we had on, we had $150 of risk for the spread. You can see 75 and 75, 150, and this moved up from that, 150 cost of the spread. It was now trading up to 330 per spread. So this was up $180. So if you did one spread, one contract, you'd be up $180, for that one contract. Or if you did 10, you're up 1,800. So, that's 120% return in that 1 day period. And this is taking advantage of the volatility collapse or crush. Now, the really cool part about it then was also then think about it. If you had wanted to stay with STZ thinking it's going to trend higher, you're long the 12 Jan. So you can just close out that 5 Jan short strike of everything, and you could stay long if you think it's going to move up higher. So that's a really great flexibility to the trade that you have by using this strategy. Okay, but it's a very low defined risk. Now this one is really cool, and this is super, super low. Look at this one. This is one we did. This was on CL. All right, so again, you can kind of look at the history, what it's done in the past. The implied move history, 2.83 up or down, 3.18 up or down, 2.97 up or down, or 3. And this was going back, this was one we did not too long ago. And so then you can see what it actually did the next day on expiration. So it was up close to 2%, down, close to 2, up, down to 2. So it was a perfect setup for this type of double calendar. And we don't care the direction, we just want it to move to our target range or close to it. So it was entered on the 25th. It was traded 80.96, expiration the next day. And so it was, then the next day it was traded 82.83. So it closed up 2.3%. And that's what we set the trade for. And that was based on the screen. So you expect to move 2.83, set the trade for 2.5%. And traded here, moved up here, volatility collapse, and we had a super low risk trade with a big return potential. So here was that 83 strike. You can see just the volatility, implied volatility just on that specific strike here of the 83 call that we were going to do, and a 46% implied volatility of that going in before the earnings were released. So we're selling that to take advantage of that high volatility, implied volatility with this structure. And then you see the next day, this thing had collapsed down to 14%. All right, so that's what we're looking to take advantage of. So set this up, didn't care about direction, just wanted it to move that 2% or 2.5% up. And so you can see the implied move was 2.83 up or down. We set it for 2.5%, had a big wide break even, so very low probability of losing on this trade. All right, so you can see that was the put calendar side, call calendar side. Look how cheap the trade, this trade was a total risk of $17, right? Now that's super low. So you had a risk here of the $11 for the call calendar, $6 for the put calendar. So a total of $17. Now the spread, it's not a huge money maker, but when you look at return on risk, it's big, and these are fun little trades to do. So the spread was on for $17. That's the max risk. Spread blew to $53. So here's your $36 per spread profit. That's a 211% return in 1 day on your risk of 17. Which in the course I'll show you how to trade this for a longer trend trade. So we did one last cycle for Halliburton where we did this 2 weeks out, and we stayed with the post trade and had a really great trade set up to capture the post trend trade up for Halliburton using this same structure. All right, so that's a really a big favor because the risk reward that you get plus that flexibility. Now, the other one that's really great for, and again, this is also market neutral. It doesn't really, you don't care if the market goes up or down. So you're taking out the risk by making a long short, what we call a pairs trade, okay? And so this is a great way to play a post-earnings trend trade, but making it market neutral by doing a pairs trade. So when we're doing a pairs or spread trade, what you basically are doing is a market neutral trade. So what the strategy does, it can be used for trading a post-earnings trend move on your stock after the earnings release. Now, by trading a pair or spread, now this is, hedge funds, we're calling it hedge funds because they're long short. And so when I was running the trading group, basically all we did were, pairs trades or spread trades because we could lower the risk, lower our margin costs, lower our risk, and neutralize it based on being long and short. And so we were going to then mitigate any overall market risk that might happen. So all we're going to do is play the relative strength of the spread. All right. So by simultaneously taking an opposite position on related securities, this is what allows you to reduce your exposure to the broad market. All right. So you're long X, short Z, and then they're correlated to some extent. So they're going to offset that or mitigate that overall market risk. So the pairs trade is then going to be equally likely to profit whether the market is, your trade goes up, down, or sideways. It doesn't matter. Now we can do this trade also, which makes it even better, by using what we call the synthetic option long short, okay? So rather than buying shares long and selling shares short, we can simulate that or make it kind of exactly the same by using a synthetic option long or short to mimic, the shares themselves. So it makes it even lower risk and actually increases your leverage to the trade, but still a very low risk trade. So I'm going to show you a couple of different examples here on, long or short Apple and and long QQQ or something related to it. So think about this. So let's say we want to, maybe Apple is really starting to trend down. So we want to be short Apple. Okay, I'll show you an example. We're going to be short Apple and we're going to be long QQQ. Now Apple is very correlated to the NASDAQ 100, right? So let's say then, QQQ, we think Apple's going to go separate from QQQ, is going to get really weak relative to QQQ that it's correlated to. So we're going to look at QQQ. We'll just do this the other way. So QQQ long and then short Apple, okay? So if QQQ goes up faster than Apple, we're going to make money on that spread widening, okay? So here's QQQ going up, Apple's kind of going down or not going much, doing anything, but QQQ is going up, so that spread is widening, right? So we're making profit on that relative strength of QQQ versus Apple. Or let's say that QQQ goes up, but Apple goes sideways, so Apple's doing nothing, but QQQ is going up. All right, and the catalyst for these types of pairs trade is the earnings release, right? So, Apple, after its earnings, the example I'll show you, had really weak performance. So it really started to break away from that correlation to QQQ. And QQQ was, like, let's say maybe going up, but Apple was going nowhere. So we had that increase in the spread. No, you cannot use a synthetic to collect a dividend. You have to be long these shares, so that's one thing. But the synthetics is, who cares about the dividend if you're doing these types of trades? So that's one thing, you don't get the dividend. So question was, can you use a synthetic long to collect a dividend payment? And no, you cannot. All right. Now, the other one is, okay, well, let's say QQQ goes sideways, but Apple goes down. So QQQ could just be going sideways, but Apple is weakening, right? Or we could have, QQQ goes down, but Apple goes down a lot faster. So you can see the spread widening there. So we're making the money on the spread difference, or QQQ could go up and Apple goes down. All right, so those are the 5 different ways that you could actually profit, on this type of trade setup versus, having to just, if you think QQQ is going to go up, you have to buy it, or if you think it's going to go down, you sell it short. But, with this type of strategy, you can actually make money 5 different ways on a pairs trade, pairing it with something else that's correlated. So the pairs trade then can be structured. What we do in the course I'll show you next Saturday, we can do these trades with a synthetic pair. So we're going to go a synthetic long. In this example, it could be long QQQ on a synthetic long using options, and short Apple based on a synthetic short. So that's the way we'll construct it. That's the way we'll construct the trade. Now, this is going to then lower the cost and also then ends the hassle of borrowing shares. Now, when you short shares, you actually have to borrow the shares in order to do the short. But as a synthetic short, we don't have to do that. So that's another advantage. So here's a good example of a pairs trade. And this is going to be Apple versus like QQQ. So you can do like Apple, has a good correlation to QQQ, or it could be Apple with the ETF, so within XLK. But here's Apple after the earnings here. You can see Apple came off, and then look at it, just went sideways, right? And then finally started trading up. All right, so this is one I'll show you here. So you can see how that Apple was really weak and then just did nothing. And then finally did start trending. Now here's another one. Here's another one that I'll show you. Here's Apple, really bad earnings, just total collapse, right? And then, moves up, but just really weak overall. Okay, so a way to do this where you don't have you have to just short Apple. If you just shorted Apple here, you did okay, but then you went sideways, so you made no money, and you probably, depending on what you did, if you did a put spread, you lost money on negative theta. But if you did this as a pairs, it offsets that, the negative theta. That's the other great thing about it. So here's what the trade setup would look like. So this is a pairs trade example to show you here. So here is Apple trading. In this one, it was trading here. This is going to be QQQ. Okay, so you're going to be long QQQ. I'll put that. Okay, long QQQ and short Apple. Now, Apple had a horrible earnings, so it started to separate from its strength to QQQ, and it's correlated with QQQ. So at that particular time, this was the earnings right here, released about that time. At that time, just if you were long QQQ, short Apple, that spread 1-to-1 was going at QQQ was $152 above per share above Apple. Now you can see Apple, was going down. I'll show you that chart in a minute. Apple went down first, and then it went sideways, and then just kind of really had a trend up. But look what happened here. So you can see the spread is this line chart right here. So this is the spread of QQQ versus Apple. So when it was set up, it was 152 over. Look at the spread. It started to widen, right? So that spread widened, and then right here, at that point there, you can see it was now at $191 over, okay? So that spread went from 152 to 191. That's per share. So 1-to-1, if you did one contract, one share to one share, you can see the spread difference here, that increased to $39 per share. Now, if you did this, if you were doing an option contract, one option contract is equivalent to 100 shares. So this would be, if we did this synthetic, which, I'll show you next weekend, you'd be up around $3,900. Okay. So that's just to show you that spread relationship. If you're not familiar with pairs trades, this is what you're trying to trade, is that relative strength between something correlated. In this example, QQQ was going to be stronger than Apple due to Apple's weak earnings. And then you can see here, just another kind of spread relationship here. Here was another earnings trade right here on the 31st. You can see Apple was trading here at 83. I mean, QQQ was trading at 183 over Apple, and then Apple started trending up and trended up. Here, the spread moved to 201. All right, so from there it was up, $18 increase or 1,800. So these spreads are a great way to capture, a relative weakness or strength. So just backing up here to Apple, you can see what happened to Apple after the earnings. It collapsed and then went sideways, okay? Now at the same time though, QQQ was having a more steady performance and moving up. And then here you can see the catalyst was, again, super ugly earnings on Apple, and then it totally collapsed while QQQ was not collapsing as much. It was holding strength, okay? So the whole market, QQQ was coming down, but it was coming down less than Apple. All right, so that's the relationship there. And here's just another one to point out. This was on Nike. You can see here Nike's earnings. This was the catalyst for the Paris trade, weak earnings. And so look what happened to Nike. It started, just price started collapsing. All right, and so it was trading right here at that 113, and then here's another one on Nike. Nike had earnings on this one series and had good earnings to the upside. Now we could trade this then with a pair. So what's correlated with Nike? That's what we're going to find. And in the course, I'll show you how to match the correlation and figure that out. So here is where we had this one. We actually had this dollar equivalent. So we made this more dollar equivalent value. So, you're trading like apples to apples. So you're not having a deviation from, one being more higher price than the other. So this is kind of making it more one-to-one. So you can see up here, it says, it's showing that correlation. So we did 4.5 shares of Nike, 4.55 to 1 share of SPY, because SPY is a lot higher value contract than Nike, so we'll make that more dollar equivalent. But so you can see here the spread. So you can see that ratio there. So I'll show you in the course how to do this. Now, so you can see here on Nike, you can see the trade was right here. This red line was after the earnings. So here's the spread. So this is going to be Nike versus SPY, right? And this is going to be actually Nike long SPY. This is Nike short SPY long. Let's see here. So here's Nike. Let's see, Nike. Yeah, Nike. Long Nike, short SPY. So the spread you can see here was Nike was 75 over, and SPY, and you can see that spread collapsed down to right here. It was then trading at 250, right here. Yeah, 250. Let me get this lined up. Hold on a second right here. You can see Nike right here was trading at 72 over, and then right here it was trading right here at 2.5. So that spread at that point, Nike, you can see this was going to be short that spread, Nike to SPY. That spread went from 72 down to 2.5. So this was up $74 or $7,400. So this spread went from 72 to collapse down to 14 under. So that's an increase of 7,450 or 7,400, basically $7,400. Okay, and then here you can see this one was Nike. Actually, after the earnings, you can see here Nike was going up and went from 14 under. That dashed yellow line had to move all the way up here to about 81.5 over. So you can just see that huge movement in the spread, right? From here, 14 under to 81.5 over. That's a huge move. That's like $95 or $9,500 if you did, one option contract. So that is the thing. This was actually basis This trade here was Nike long right there and short SPY. All right, so that's the main one right there. So this one is, this is the one I was trying to illustrate here. So this is Nike long. So you'd be long about 4 shares of Nike, short 1 share of SPY, and that spread went from 14 under to 81.5 over. So huge move there. All right, so that's how that spread can work, and you're market neutral. So it doesn't matter if the markets are going up or down, you're playing that spread relative value of Nike being stronger in this example than SPY that it's correlated to. So that's what I'll show you next Saturday or next week as well. You know, how to pick it and then how to structure it based on the correlation, how to figure out the correlation. I'll show you all the data on that and how to use it. And what is the risk on Nike? So the risk on this trade, it would be, so the risk on this trade is going to be basically the spread value. So if you went long the spread, it could be maybe, I'll show you in some examples next weekend, but the risk will be like just the spread risk. So you could have the spread value here is 14 under, so that's like $14. So your max risk would be $14. If you're looking at this, if you bought this spread here at that point where Nike was trading at $14 under SPY, your risk is that basically $14. Okay, so $14, per share, and if you did 100 shares, $1,400. So it's kind of like that's how you can see what your total risk would be. All right, so but then when we're using the synthetics, it's going to be something similar to that, but it's going to be more leverage, but the same kind of value, when you look at the maximum risk. So you're looking at just the spread value. So the spread value could be $10 or something. So it just depends on where you put the spread on, et cetera. So that's what we'll cover in the course, how you can look at your risk reward on that, and it's going to be based on your margin that you're using, and so how to construct the synthetic long short. And so what we're going to do is I'll show you how to do this with options, where basically you're going to be able to do say a naked short on a call or naked put, but we're going to do that as a spread so we can alleviate your kind of margin risk on it. So there are a couple of different steps involved to doing it, but it's a really great strategy to do, for synthetics. And the other thing that we, I just did a course not long ago on just doing synthetic longs for covered calls. Okay, so really, really great way. So think about it. So if you wanted to do a covered call strategy on a specific stock, you can, instead of buying the stock, we can just do a synthetic long on the stock, making it more efficient and less costly, and just, riding that whole trend up and selling calls against it. So it's another way that you can kind of use this kind of strategy. But for next weekend, I'm going to show you how you can use it for an earnings post trend trade, long short. Now, will every trade be a winner? No. It'd be great if we could have all of our trades winners, but that's not going to be the case. And if everything was a winner, then you'd probably get bored with it. But what we're going to do in this course is really comes down to your screening and scanning. We're going to be looking for really high probability trade selective trade setups that are very selective based on the screening process that I'll take you through next weekend. So let's talk more about what I'm going to be putting together for everybody next weekend, and this is going to be how you can capitalize on these trades using these specific spreads, and we're going to go into greater detail, and I'll show you everything here that we're going to cover and more details on that. So again, use that link that I gave you earlier, powercycletrading.com/special, right? So click on that, and that's going to pull up your payment link. Now here's a really great feedback that I got not too long ago from Mark, who did this course. He actually had another course, and then he had taken a couple different ones, but then he got the earnings course, and he said, just just to kind of give you an idea of the course, et cetera, what you're going to get. He said, Larry's a great teacher. I've had a few, and Larry by far is the best. I also enjoyed his earnings course. I made 3 trades in the past couple of weeks. Larry would be happy. I followed his teachings and traded Broadcom or AVGO for 1,000% winner. I must say I'm not sure if things are finally starting to click for me or if it's Larry's awesome teaching, but I'm trading better than I have traded in the past 3 years, closer to 4 now. It's probably a combo. And anyway, I'm not tooting my horn. I just wanted to leave a comment that is positive for Larry. So I've been through a lot of different programs, seminars, trading groups. What you're doing here is by far the best in my opinion. So just kind of give you an idea if you haven't ever taken any of my courses of, kind of what I try to present to everybody. And that's a little bit of nice feedback there from Mark. Thank you so much. So again, if you want to do this with this link here today, you're going to get 15% off. Just put in that earn 15, and that'll give you that discount of 15% off when you pull up that link here. So again, just go and either copy it or paste it in. Here it is. If you paste, if I can get this to move over. So copy or paste or put in powercycletrading.com/special. And it's going to pull up this drop down for you that you can use. And then put in that earn 15 small cap. It's taking a little time here. Okay, again, here it'll pull up and then put in earn 15, and you'll get everything here today for $167 if you do that package, or if you want it with the alert service. And this comes with all 5 of my alerts for the next 4 months plus the trade club and everything in package 1, all the bonuses. You can just put it in here, click on that, and then put in earn 15, and you're good to go right here. And again, if you do want my indicators, they're down here. You can add that to your cart, and you're going to get the trading tools that I use for pretty much all of these trades that we do at Power Cycle Trading. Plug that in, and boom. So you're going to get all that good stuff there real quick. So this is everything you'll get. Again, you'll get you're actually going to get my 7-hour earnings course. This is more on more really geared towards the option Greek. So really great course. My trading club 30 days membership. Then if you decide to stay on, please do. It's $97 a month, or we have other different packages that you can do, or you can do the alert service. Then you're going to get my start trading options today. That's going to be included. We'll do a live Q&A that's live and recorded for the course. This will be the day after on Tuesday. You'll get my best earnings trading list. I'll give you my list for my 3 screens, but in the course, I'm going to teach you how to do the screening and what I use for the screens. So the course value, package value, I said, all the bonuses that are included total up to $2,600 in today, or $167, using the link that I showed you. And then if you want it with the alert service, again, you can get, you'll get all 5 of my alert services for the next 4 months, and the trading club for 4 months. And these will give you either, butterflies or condors that we do, selective, calendar diagonals, maybe butterflies or calendars for pinning trades, which are really cool. I'll show you a couple of examples. Breakout reversal trades and earnings. So these are the kind of 5 selective categories that of trades that may be sent out to you. And then, this will be 507. So just pull up that link, put in the code EARN15, and you'll get 507. And there's a 2-pay if you want it. But basically, I'll just kind of scroll through here. You'll get 8 to 12. Either I do stocks or ETFs only per month, and these are kind of swing trades. So it depends on the trade setup based on the chart pattern, my indicators, et cetera. So last week I'll show you one that we did that we're still in. We did one on XLE. We did a calendar diagonal on that. We did before that we did a nice long condor on Apple. So a lot of different variations of trades based on these 5 different potential alerts that I might send out. So either butterflies or condors, calendars, monthly pinning trades, which I'll show you, breakout reversals. These are either debit spreads or credit spreads, and then the selective earnings trades, which could be any of the various ones that I showed you today, which we'll go through in detail next week. So when I do send these trades out, I send out the trading guide. Now, a lot of my members that are members of the alert service, all they want are my trade picks, right? And then they'll do their own thing. They may just buy the shares, short shares, buy calls or puts. But when I send out a trade, I always give you a specific option spread trade, okay? And so then that way it makes, these are low risk trades that I send out based on options. I do a setup video review that day after the close of the trade that was sent out or set up. Trades are listed in archives, so you can go back and look at them. Then we do a weekly Q&A every week that's live and recorded, so you'll have that for the next 4 months. Video newsletter every day after the market for the next 4 months, you'll have that. And then here's a big benefit. You'll have access to my virtual trading room, which is open each day during the week from 8:30 to 10:30, 9:30 Central for the next 4 months. So you can come in and ask questions on any trades that you have on that you need help with or see what we're doing. And then anything on my website, you'll get a 60% discount. You'll get a members code that gives you a 60% discount on anything on my site. So going through here, again, I'll show you a couple of different trades that we've done to get an idea, but we've had real high winning percentage, which is kind of the goal. So we've had 819 trades closed out, going back to May 2028. 589 winners, 54 break even, 176 losers, 79 win rate, again, unaudited, but these are kind of the summary. And then the earnings trades, again, are very selective, and we've had 128, 91 winners, 16 break even, 21 losers, 84% win rate. These are, a combination of double calendars, credit spreads, things like that. And then you see here your membership there, what you can get. Make sure you check down here to see if you do have been a member. If you bought the course before, it'll be listed right there on under your user profile, so you can check that out. And then also, some people have wondered about the bonuses, right? Now these are just included. The course package, the value, the price of this course is $197. But I'm just giving you these additional bonuses. I think these are things that are going to help you with your trade, so that's why I give them to you. You might maybe already have them, but anyway, that's what comes with the package. And again, if you use a promo code, you're going to get 167 today on that. So just kind of clarify that. We have questions sometimes on that, on the bonuses, if you can check, substitute, things like that. Now, here's what we're going to cover in the course starting next Saturday. We're going to go through the 5 steps to the perfect trade setup, the analysis and the tools that I use for that. We're going to go through the the screening, 7 steps I use for the screening process that I use to identify these high probable winner trades. We're going to go through option pricing, the importance, how to do the pricing for your weekly options, how important it is, and what the components, how those work. Then I'm going to give you my resources that I use. A secret resource for the statistics that I use for the earnings history that we're going to use in the course to do the screenings, to find the stocks that we want to do based on the probabilities of either big moves up, big moves down, or sideways. So there's a good screening process I use and the sources I use for that. And then how to quickly scan and capitalize on the earnings data. I'm going to go through the data, show you how to use it, and then how to then identify, okay, what strategy do we use based on what we're seeing on the screen? So that's a big part of the course. And then how do you analyze the stock's earnings release, move up or down, using the expected move. The best weekly option strategy then to apply to it based on, the screen, what we come up with on that. And then my formula to create this kind of really good, efficient watch list for these high probability trades. Okay, so a big part of the course will be spent, the first part will be spent on the screening process. And then the second part, part 1 and 2, we're going to get into the actual trades, okay, to construct. So it's going to be covering the long iron condor, which is what I call the high probability credit spread for volatility collapse. And then the other one we'll cover will be the iron condor debit spread. This will be the one for the big price spikes. And then the kind of go-to one, my favorite, if it's appropriate based on the screen, will be the double calendar. That'll be covered in the course, okay? And so here's a little feedback. And basically the double calendar is like one of the best strategies I've found in general. And it's just a great overall strategy. We do a lot of calendars, but when you don't have an idea of direction up or down, that's when that double calendar is a great one to use. So you're going to learn in depth how and when to use this strategy based on the 10 steps that I use. Now we'll go into detail on the earnings double calendar, how to choose the optimal option price, strike price, how to structure the initial setup through the option expiration, okay? And then how to make adjustments if we need to what we try to do if we stay with the double calendar for an extended period of time, maybe a week or extend out. We want to try to see if we can trade it or turn it into a free trade where we have zero risk. So this is kind of the ultimate goal, and I'll show you how we do that and how to plan for that. So question, on the pairs trade, Apple and QQQ, would you buy puts on one and calls on the other, or would you have to put? No, that's not no, that is not how you will do it. Now think about this. So that's what you're going to learn in the course. So you want to do it where you're getting a positive theta or neutral on theta. So think about it. So let's say you want to do a pairs trade on QQQ long, Apple short. So if you went out and you bought calls on QQQ, let's say, and you bought puts, so you're long QQQ with a call, right? And you bought puts with Apple, so you're long puts, right? Now, what if it goes sideways and doesn't move? Well, you're going to lose on the calls, you're going to lose on the puts because of negative theta. So in the course, I'm going to show you how to do this synthetic where you're long short. So your long is going to have what we call a negative theta. Your short is going to have a positive theta, which offsets that. So it makes a mimic of the underlying stock, okay? So it's a really cool way to do it. So that's what you're going to learn, in the course, how to construct that. All right, so that is a big part of the course, is the proper way to do that. All right, so that'll be taken up there next weekend. So hopefully you'll join us to learn that part of the course. So then the other part, then we'll go through the earnings pairs trade strategy, and this will be live. Also, everything's being recorded. So when you go through a pairs trade, it's again a market neutral strategy that can be used for these post earnings trend moves on a stock after its earnings. Strategy is totally without the change of, it's a really great game changer because you can trade in a high volatility market and you're not really dependent on market direction. You're just looking at the relative strength or weakness between one stock versus another based on the correlation. And we'll go through the correlation, how you figure that out, how you match it, all that good stuff. And so we're going to go through how to identify and select the best earning stock pairs for your trades, the statistics for measuring the pairs trade correlation to identify the best trade matchup, the resources I use for that. So I'll show you that, how that's done, and the resources I use for that correlation data. And then when and how to set the earnings trade, pairs trade up, and then how to do it using a synthetic long or short option structure to execute the trade, and then how to monitor it and do all that. So that's a big part. Now you're going to also get another part of the course that you're going to get is going to be just kind of a recorded on-demand part, but this will be just more of the course, but really geared to show you these three strategies again. So it's going to be a recorded course, but this will come in addition to the live course that will start next weekend. But the recorded course will be basically, again, on the long iron condor, the iron butterfly and the short iron condor. Okay, so that's just an additional plus there that you're going to get. And then you're going to get my earnings option strategy guide. So this shows you how, why, and when to use these trading examples or these trades with examples on each. And so it's going to be showing you how to do the earnings implied move calculation, how that's done, how we use that for each trade, how and when to set up all trades, and then how to manage into expiration. And you'll get a good trading library that you can go back and look at various earnings trades to kind of see how they work. So a really great way to learn in your trading is just go back and look at past trades and see how they were constructed, how they work, and that gives you a better idea. So you'll get a good earnings library there. Various things like Apple, Google, these are all earnings trades from past earnings trades that you'll have access to go back and look at, which gives you a really good way to learn how to do the trades. So you'll get that. Here's a little feedback. Here's from Mary, one of my clients. She said, this course explained in clear and simple terms how to trade options on stocks that were coming into the earnings report. Larry showed the specific sources of information used to determine which strategy is most appropriate for the stock that's being reported based on the historical data. So you'll get my data research stuff that I use there, how to use it. He gave very specific guidelines as how to use each and exit strategies, goes through the material in great detail and shows examples of the strategies from past performance. One thing that impresses me with each course I've taken is his willingness to repeat explanations if someone asks for clarification. Larry schedules classes for a certain time frame, and because he wants to ensure each participant has understood the information, he most often goes over the planned time because he stops to answer questions. So that kind of summarizes the way I try to approach every course to make sure everybody comes away, with the answers they need if they have a question. So I'm there to, give you that extra on the course. All right, so that's a little feedback there. Now you're going to get my on-demand 3 parts earnings course. So this is a 7-hour course that you're going to get to start with. This is again more geared with a lot of more on the Greeks, and so you're going to get this. So you'll get this on-demand course, 7+ hours, broken down in modules, so you can go back and use it. You'll get the PowerPoint of the course, 4 weekly option strategies that work regardless of the direction. So these again will be covered calendar. Things that we're going to cover in the live course, but this is one that you can get started with right away. And so it then gives you the complete option guide with in-depth explanation, trade examples. So just a really great way to get you started right out of the gate. So you're going to get that right away. And then bonus 2, you're going to get a 30-day trial membership to my trading club. Now, if you do the alert service, you'll get this for the next 4 months, the trading club. Now with the trading club, you're going to get access to my virtual trading room. So it's open from 9:30 to 10:30 Eastern, Monday through Friday. So come in if you've got a trade that you have a problem with, or if you've got a trade that you want to look at, come on in, put it up, and we'll look at that. I'll give you my 2 cents on, what you could do if you're, in trouble with the trade, or if you're thinking about a trade, just come in to do that, or what we're doing in the room. I do a daily video update and newsletter every day after the close. The trades are archived, our videos are archived. We do a weekly Q&A every week, live and recorded. And then you'll also have access to your Traders Educational Vault. This is part of the membership, and 60% discounts on any courses or trading software on my website. Now, here's a good one that I like to point out from Jay. He says, reading books is fine, but seeing the actual option trade setup makes a huge difference. And that's what you're going to get when you come into the room every day. Yeah, I'm looking forward to seeing you there. And you'll get the recording and everything. Yeah, thank you. Yeah, I'm looking forward to it. Now, again, if you go to Power Cycle Trading, you can see here, as a member, you'll get your discount code on everything that is on the website. So you'll get 60% off. If I can get this pulled up, I'll show you real quick. So once you're a member, then you'll get a member's code that will use on anything in your courses or so if you want any of my trading softwares, our indicators or scanners, you can come in here, click on trading software, and pull this up. Let's say you want my volatility breakout scanner that does what I typically use to find a lot of the trades. You just come in here and you click down here as a member, just click on more detail. This thing is just jumping around. I mean, here's a scanner, but you can see it's for Thinkorswim TradeStation. Click on that, come down here, add to your cart. It's $3.97, but you put your members code in and you're going to get 60% off that price of $3.97. Just put your promo code in here, which you'll get once you're a member. Put that in, you'll get the course for 6% off that. Or if you want any of my other courses, pretty much all my courses are somewhat geared with options. Here's that Get Started Trading Options. Now this is a bonus course for this, what you're buying today. This is one that I gave you as a bonus. So you'll get that. You'll get if you want my Ultimate Option Guide course, let's say, you can come down here, click on that, come down here. That course goes for $5.97, but you come down here, click, 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 and put in your promo code here. You'll get this for 60% off. All right, so that's a big bonus there, 60% off of courses and trade software. And then start trading options today. So you saw that on the website. You're going to get this. This is kind of intermediate option beginners course, but it's a great course to get you started if you're just starting out with options. So this basically is going to cover the benefits of options versus stocks. What you need to know, the basics of options, mastering puts versus calls, how option expiration works. And there are 3 strategies I cover in the course: covered calls, protective put, covered call, and then the vertical debit spread. So it's a really good additional course for you to have for your trading library on options. So you get that as a bonus. And then we'll do a follow-up Q&A, which will be live and recorded. We'll do this Tuesday after the course. We'll have Monday, we'll be finish up with the course, and then Tuesday we'll do a Q&A on it. And plus you've got the access to your virtual trading room for the next 30 days. And then you're going to get another short course here. This is a really nice course, just pretty much on the Greek. So it's a 60-page option guide with videos on the Greek. So, delta, gamma, theta, how those work, option pricing, standard deviation, option delta, trade probability. So all these bonuses are kind of option, option bonuses for your library. And then I'm going to give you 3 earnings stock lists. Okay, so these are based on my screen that you're going to learn in the course, but I'll give you these ahead of time. So these are going to be based on max move of 5 or 7% or greater than 5%. So you can kind of see here from the last go around what this would look like. So here's kind of max move. This is using the scan that we'll go through in the course. So you can see some of the stocks that came up, J&J down to ADP, MDLZ, et cetera. So you can see the market, recent close, average volume, when the earnings dates are, and this tells you, if it's before or after the close. So these are based on the screens that you're going to learn in the course. So that's an idea of max move of 7 that popped up last go around, max moves of 5. So you can see Microsoft, and then here, these big explosive moves greater than 5%. So you can see here, Google, AMG, Team, Shop, all these are potential big movers based on the screen. And then are the scanners available for TradingView? I do not have the scanner for TradingView, but if you use Thinkorswim, you can join Thinkorswim as a free platform. Basically, you just open an account at Schwab and you can get access to Thinkorswim. That's a great scanner. And here are some examples of the alerts, so you can get an idea there if you want to do the alert service. And so again, use here, Deborah, make sure you use this link here, powercycletrading.com/special, and use that promo code EARN15. And here I'm going to show you just a couple of examples of the alert service trade. Here's some feedback from Dan. He says, you're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you as I was learning how to trade options. So please feel free to share this with other participants. Dan, And then Scotty says, it'll be the best investment that you ever make. Go with the elite package, great group of traders in the trading club. So that is for sure, everybody. We've got a great group that comes each and every day. So please join us. And again, here's just kind of a summary of what you'll get with the alert service. Again, a lot of people just want the trade setup. So when I send out, I'll give you a suggested option spread trade. I give you the entry level profit targets based on what I call my option pricing or my price target analysis, which involves unusual option activity, moving averages, fib levels, etc. With the alert that I send out, I'll give you the option series to use, stop loss guidelines. Trades are listed in archive, so you can go back and look at them if you want. And that's what you'll get there. You'll get a trade setup video review that day after the trade's put on to kind of go through why I did it, why I selected it. And then I also do the daily video newsletter, which goes through what happened during the day, what's my outlook for the next day, etc. And then we do that weekly Q&A every week, which is live recorded. So you have this for the next 4 months. Access to virtual trading room for the next 4 months. Those discounts off there. And then here is a summary again, earnings. I think we went through that. And here's some trade alerts that we just recently did. Here's kind of you can get an idea of the calendar diagonals that we send out. So started this service back in June of 2019 through Friday, yesterday. We've had 319 trades closed out, 231 winners, 18 break even, 70 losers, 78% win rate, unaudited. All right, we do a lot of these calendars and calendar diagonals. And here's kind of one that we just did this past week, or we put this on the 31st. And so you can see this was on XLE, the energy ETF. It says new XLE long trading at 85.70, daily cycle low reversal, breaking back above prior week's high, daily positive momentum. This use my trading indicators, which if you want, you can get access to. And then it says with an upside cross, target 1, 87, target 2, 90. Says here buy a diagonal, 17 Jan, 3 Jan, 86, 87.5 call at around $1.25. And then on last week on the 2nd, we did an adjustment right at towards the end of the day. It was trading now, it had gone from 85.70. Now it's trading at 86.70. We did an adjustment, which I sent out. Okay, so I'm constantly updating these things if you need, to profit take, adjust, things like that. So it says here's the adjustment, buy to close, the 87.5 call, sell to open, the 10 Jan 88.5. So now we had long the 86, 88.5 call, and then here was a profit take, partial profit take that we had on Friday. Now XLE was trading at 87.50. If long, this adjusted trade, take some profit on this run up, hold balance with a break even stop. So now it was up $85 or 84% return. So this was just a real recent one from last week. So we set this up. This was a really great trade. It looks real good still. So we set it up right here. You see the values right here. So momentum is pushing up. Good setup here. So here it was. We took a little profit there on Friday. And here's the calendar that we set up, the adjusted calendar here. So we've got this that we adjusted this then on the 2nd when it was trading 86.70. So now we've got this, we're long the 86 call, 17 Jan, short the 10 Jan, 88.5 at $1.01. That's the spread width. That's the spread cost. So that's our max risk. And then you can see here on Friday, it was trading at 186. So it was up $85 per spread, 84% return. Now we're still in the trade too. This is just to take some profit, to kind of what I call a trading edge. And here's what that trade looks like. I can pull it up real quick for you. Let me pull that up. Bear with me. Now this thing wants to take a rest. So here's XLE, and this one has really good potential. I'll show you this real quick and then we'll move on. So this is the energy ETF, and this was a calendar spread that I did on this one. And is Thinkorswim available in Canada? I'm not sure, but I have the indicators also for eSignal and NinjaTrader and TradingView. And Wealth Charts. Okay, man, this thing is really grinding slow here today. Let me show you this XLE trade, and then we'll move on. All right, so here's XLE. So this is based on the indicators. So what I look at here, just kind of summary, is first thing we can see. You can see there's a what we call a cycle reversal right here. See that crossing there? See that arrow there? And then see we have momentum shifting up. See the momentum starting to shift here. And so then I like to use this 4-hour combination with the daily. You can see the momentum's up. So we did the trade right here on the 31st, right there. Bought it right there. Now we're currently right there. So send out an alert to take a little profit to give yourself a little trading edge, and then we can set a break-even stop or adjusted break-even stop. But this has still really good upside potential. So now we're long this adjusted counter diagonal at $1 right here. Okay, so now we've got our short strike is for next Friday, the 10 Jan at 88.5. Now, if we get to 88.5 next Friday, this thing will be up $170 on the risk of 101. Now, on this past Friday, this went up about 8. That's not exactly right. It went up about 80. It was up about $85 right here. All right, so it still looks really good on that. Did that one, and we did one other one too. We did another one here. I'll just show you real quick. We did a long trade on that was alert trade sent out on Friday, CCJ. We did another counter diagonal on this one. So we did this trade. This was a counter diagonal we did similar to the one that we just did on XLE. So these are what you can expect, you know. And then we did this trade here was on CCJ. So we set this one up, bought the 53 Jan 17 call, sold against it next Friday, the $55.25, potential profit $128. But we're looking at this one. Maybe if we get a bigger move, we're going to adjust this to maybe a butterfly, something like that. But this is kind of what you can expect with the alert service. So that's a look there on a couple that we just recently did and we still have on. And then here's just a couple others. And then any other questions, let me know. Let's see. Yeah. Right, swab owns, yeah. I would, you know, you can look at TradingView. You should be able to use TradingView. Okay, nice little platform. And then here's one we did not long ago. This was on NVIDIA. So we did NVIDIA trade. This was again a long call counter diagonal. So set this up on the 23rd, trade at 136.90. And then we did an adjustment on the 23rd, that same day. And then now it's trading at 142.70. So I'm constantly updating these things if you need to, you know, do anything. And then we had some profit take on the 24th. Now it's trading at 141.80. So we had a nice move from 136 up there, $143 per spread, 164% return. So here's, you know, kind of, we use Telegram. It's a free service that you use. When I send out the alerts, this goes out within seconds. So that was one that was just set up, and that was on NVIDIA. And you can see here, we set this up right here, took profit there. So here was the counter diagonal, profit take on this on the 24th. Now it's trading at 141.75. So you can see the spread went from 413 to 553. So it was up $140 per spread or 34% return. Okay, on that. And then actually this, we also had an adjustment here. I left that out, but we did this adjustment to even optimize it more, but didn't show that one. Then here's another one we did. This was a short trade that we had on XLV. It was a put counter diagonal set up on the 10th of December. It was trading at 144, did an adjustment on the 11th. Now it's trading down to 142.70. This one was a really great trade, and I'll show you, just kind of step you through. So here are the alerts that are sent out, new XLV short. You know, it shows you all the detail there, very detailed description. Set the trade up here short right here. Right there, going short here on the 10th, straight at 144.10. And then we had a nice collapse down here, okay? We had an adjustment the next day on the 11th, converted this to a put debit spread, and then we profited on the 13th. Okay, so we changed this into debit spread to increase the profit potential, et cetera. So here it was originally, we had the original trade set up here on the 20th, the 10th, and then we adjusted it on the 11th to put debit spread, but here's where it was on the 11th before we did the adjustment. It was from, we want to see the risk here was 70 bucks, it was up at 102, so it was up a little bit, but we adjusted this trade to a put debit spread, which turned out really good. All right, so we went ahead and adjusted it, and with the adjustment, we adjusted it to this put debit spread, where now we're long that 144 put that was the original long, 20 Ds, but we sold against it the 20 Ds 141 put. So we have a put debit spread 144, 141 at our adjusted price of $87. Potential profit would be 213, 244% return. So we went to 87 risk spread with a 300, so potential to make 213. So these were the adjustments sent out, and then here's where we had some profit took profit there on the 13th, right here. It was trading at, right there, 140.62. So it went from 87 to 230. So the spread was now up $143 or 164% return. So that was a really nice one on that. And then here are a couple others. These are kind of butterflies recently that we've done. So we started this part of the alert service back in May 2019. And through Friday, we've got 198 trades closed out, 141 of those winners, 14 break even, 43 losers, 78% win rate. Now, these are very low risk, potential high reward. So these can be anywhere from risk of an average risk of about 75, 80 bucks because of the way the spreads are constructed. But these can give you 2 to 1 up to 25 to 1 sometimes. So these are really cool trades. And here's one that we recently did. This was on Apple. Set this up on the 21st of November. Apple's trading at 228.80. And then we took it off on the 29th. It was trading at 235.74. So here's the alert that was sent out. You can just kind of, I'll go through these kind of quick, but new Apple long trading at 228.80. Holding support at the daily 50, daily positive momentum, upside cross. Target 232, next target 234. Buy the condor, go through here, and here was the trade, what it looked like. So set this up right there. See my indicators. All these trades are very, very similar as far as what I'm looking for with the indicator. Cycle reversal, positive momentum, breaking a key area of support or resistance. Big, huge move up on that one. And did this as they call condor here, where we had a total risk. Always look at the risk first. So we had a total risk of $82, and then we had a potential to make 168. Okay, so 82 risk with the potential of 168. That's a 204% return. So this is what we call a long call condor, where we're long the we're long that call debit spread, and we're short another credit spread against it to reduce risk, reduce data. So you can see here long the 230, short the 232.5, then short the 237.5, 240. So this gives us what we call the Condor debit spread, which is a great trade, positive theta, very low risk. And you can see this trade then was going out right where we want it to. So it went from 82 was our spread cost to 249. So now we're up $167, 203% return right there. So that was a really nice Condor trade setup. And here was just one other one. Here was one we did on IWM put, that was put Condor. Set this up on the 14th. It was trading at 234.80. This is a real short-term trade. Then on the 15th, the next day, we took it off, traded at 228.48. So this was a kind of this was just a really quick momentum short trade that we set up and took it off right here. So it went from 34 bucks. This was a super low risk trade, but what I call momentum kind of short trade. So debit cost 34 bucks was our risk. And then you can see the spread blew to 174. So we had a, profit of 140 per spread, or 411% return in that 1 day period on that momentum short with a Condor. And then these are really cool. These are the other parts of that may be sent out for selective, what we call lotto ticket penny trades. So this is one that we did on Tesla. This one keeps amazing me every time I look at it. So this one we did for a pin for Tesla. This was back in February, but it was trading at 189.35. And then we took our profit. It was the 16th. It was trading right where we were looking for the pin at 200. So this spread, this was up $231 per spread. That's 1,925% return over that 8 day period. So this is why we call it lotto trade. You see it says new Tesla long binary monthly butterfly penning setup, trade at 189.35, trade set up for a potential monthly expiration pin at 200 next Friday. Here's the trade. Buy the butterfly right here at around 12 cents, or 12, that's $12. That's the max risk. And then you can see on the 16th, it says butterfly penny trade, trading at 200, butterfly going up about $250 per spread. Now it's up $1,791. And here it was going out into the close. At the end of the day, I said, wow, almost perfect pin. Actually, it was a perfect pin. It was trading at 200, and now the spread was at $230, or 1,916% return. So that was a really cool. Now we don't keep the whole trade on for that pin. We'll just scale out, but we try to leave some on for that expiration. So it was set up right here, and here it was pinning right at 200. Let me get this page to change here. Okay. So this is why we call it a lotto, because the risk on this trade was only 12 cents, which is $12 per option contract. Okay. So we had this long 197.5 call, short the 200, short the 200, long the 205, 202.5. $12 is the risk, $2.50 wide spread, 250 spread width less your cost, 238. Potential to make 1,983% return. And this thing made very close to that. So here it was, perfect pin. Now we were, scaling out, but at the end of the day, this was up huge, and right at the end of the day, it expired. It was going out right there at 200. So the spread went from 12 bucks or 12 cents to 250. So this was up $238, 1,983% return there. Or if you got anything close to it, you made over 1,000%. And here's just one other one that we did. This was the one on GLD, was just another penny trade. GLD is another good one that we'll do from time to time. This was back in August, 222.85. We were looking for a pin up to 230. And so we got pretty close to it. So this went out up $233, 700% return. So we had this trade set up. We originally were targeting 225, did an adjustment, and then ended up in this trade at an adjusted price of about $25. I'll show you here in a minute. And then on the 16th, we were taking profits. So you can see here it was going out here, trading around 230.50, looking good for a pin at 230, currently up around $200 per spread or 689% return. So this is another penny trade that was sent out with the alert service and set up right here. And here it was going out at expiration. So it was right here. There was the trade setup. You can see the profile here. So this was long the 227, short that 230, short the 230, long the 233. $3 wide spread, 300 bucks. Our adjusted cost was $29, 29 cents, 29 bucks. If we got that perfect pin, we'd be up 271 or 934% return, but we got pretty close and we made 700. And we had a nice return on this. If I can get rid of this pin. So this went out, going out right here at 230.47. So we were up from 29 to 232. So went out up $203 per spread, 700% return on that. So that was just kind of review there. And, again, please do sign up and look forward to seeing a bunch of you next weekend. So again, use this special link here and then use Earn 15 to get that 15% discount. And I look forward to working with everybody next weekend. I'll see a bunch of you back Monday, so appreciate you being here. And let's see if there are any other questions. Oh yeah, sure, Shen, hold on. Let me do that real quick. Yeah, any other, wait 1 second, Shen. Whoa. Yeah, let me, hold on 1 second. I'm trying to answer your question real quick here. Find the link for you here. Yeah, 1 second, I'll get it for you. I'm gonna need to do shutdown. Something's really clogging up my old system here.